Hello and welcome back to the Female Property Expert podcast. I'm your host, Emma Morby, and today we're going to dive into a quite crucial topic for property investors, and that is understanding the property market cycle. So property markets, like any other market, go through cycles of kind of growth and then correction. And these cycles are influenced by various factors such as economic factors, government policy, and kind of market dynamics. So as an investor, it's essential that you recognize these cycles and that you adapt your strategies accordingly. Now, there are basically 4 phases of the property market cycle, and I'm going to kind of break down each typical phase of that cycle. So first, you've got the boom phase. Now, this is the phase of rapid growth and high demand. So property prices often soar and investors see kind of significant capital appreciation on the properties they own. Rental yields may decrease as prices rise kind of faster than rental incomes can keep up with. Then we have what we call a plateau phase. So following the boom, the market kind of reaches a plateau. So the property prices stabilize and growth starts to slow down. But demand remains steady, not all the same kind of frantic pace as during the boom, but it does remain quite high and steady. Then you get the decline phase. Now, in this phase, the markets start to correct. So property prices may kind of fall or stagnate, and it's leading to kind of decreased investor confidence, where people kind of sit and they want to watch and wait and see what goes on. Rental yields may improve, actually, ironically, as prices adjust. And then finally, we have the recovery phase. So after the decline, the market then begins to recover. So property prices start to kind of rise again, signaling a new start to the cycle. This kind of brings investor confidence and it kind of returns in droves, and then the demand actually picks up. And I think as a property investor, navigating that market cycle is important. So the question is, how can investors like you navigate these market cycles effectively? And here's a few tips. So start with research and analysis. So stay informed, keep a pulse on the economic indicators such as GDP growth, inflation rates, and interest rates. Monitor market trends in your target areas and include property price movements, rental yields, and vacancy rates. Subscribe to industry publications, attend sort of education seminars, and follow reputable property market analysts for insights. I say reputable because there's a lot of people out there that aren't. And I want to give you an idea. I've just told you how to do that, but I want to give you an idea of where you can find this information for free. So let's start with Land Registry. So the UK Land Registry offers free access to kind of historical property price data. So visit Land Registry's website and use their price paid for data tool. And then you can search for past property sales and prices. Now, this data includes details such as sale prices, date of sale, property type, address, but it is slightly out of date because they're running 6 months or more behind. Then you can go to the ONS, or the Office of National Statistics. So the ONS provides kind of economic data, including sort of historic trends and the impact that's had on the property market. So explore their website for reports on inflation, on GDP growth, and on interest rate changes. Now, the ONS's house price index offers insights into kind of regional property price movements, which is quite helpful. The HM Land Registry house price index is also published regularly. It's in brackets, it's kind of the HPI. That's what it stands for. It's kind of a monthly price index report. And this report includes data on property prices, sales volumes across different regions in England and Wales. Access to the HPI reports on the official UK government websites are available for anyone. And then you can go to things like property portals, so websites like Rightmove, Zoopla, On the Market, and look at kind of property listings, historic sold prices. Users can search for properties in specific areas, view past sale prices, and I suppose understand the market trends in that way. Look for the kind of sold prices or the house prices section on the portal when you're there. And also I find local councils and authorities quite good at offering property market reports and data in their own respective areas. So visit kind of official websites of your local authority and navigate to kind of housing or planning section normally. And they may provide insights into property trends, like planning applications, development projects, and that sort of thing. Now, not every local authority does this, but some are really good and they do. And then you can do kind of research reports and articles. So explore research reports and articles from what I class as reputable sources, such as industry publications, news websites, and like research firms. Websites like Property Industry Eye, Property Week, The Guardian's property section often features kind of market analysis and insights. Now, you do have to pay for some of these, but they are quite minimal. Check university research papers and kind of think tanks, I suppose, for in-depth studies on property market trends. Now, this is quite hard to find, but if you do find yourself with a source of information like this, make sure you keep that source open, because as students come through, they tend to update that relevant data. And also the Bank of England. So the Bank of England's website offers reports and publications, should I say, on economic indicators. So you can access their kind of monetary policy summary and agent summary of business conditions, I think it is, for insights into kind of economic trends, interest rates, and what impact has on the property market. Now, historic data analysis. So this is studying like historic property market data to identify reoccurring patterns and trends, are quite good when using various different tools that I've just explained, and looking at past market cycles to understand how property prices behaved during kind of different economic conditions is really important. Also, you can analyse factors such as the impact on interest rate changes and government policies, because that can have quite an impact, and just actually the global economic events on the property market in general. Utilising tools and reports, for me, this is probably where you get more regular data from. So use property market reports and forecasts that are provided by reputable firms, and this can be like Savills or Frank Knight, and use those online tools and platforms that I've said to you that offer property data and analytics, such as rental yield calculators, investment property analyst software, etc., 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 because that's what you can do from your day-to-day point of view. Now, these tools are more for you to make an informed decision based on kind of data-driven insights. And so although you're going to look at them, it's more to understand where the trends sit, how the data changes, and why that data changes. The other thing is, when you're considering looking at property investments and how you are going to manage that market cycle, you need to start looking at sort of diversification as well in your portfolio. So this is property types and locations. So they're not one type of property in one location. So spread your investments across different types of property. And this can be, residential, but it could be all different types of residential. It could be commercial, or it could be industrial, to be fair. And I think if you diversify across various locations, it also reduces the exposure to kind of localized market risks. So if something happens in that particular area, you're not necessarily affected with your whole portfolio. And consider factors like, regional economic growth, employment opportunities are quite good, and infrastructure development, kind of when you're making the selection at certain locations. I'd also advise that you kind of explore alternative property strategies. So you don't just have one sort of strategy like all buy to lets. So consider things like HMOs or serviced accommodation, rent to rent, buy to lets, couple of property flips, whatever it might be, because things like HMOs can provide high rental yields, but require what I consider careful management and compliance with regulations. Whereas, serviced accommodation can offer, this is where you offer short-term rental property, and the rental income with that is flexible, and you can adjust the pricing based on demand. So you can see much better returns. Another way of kind of understanding the property market cycles are having emergency funds. So maintain an emergency fund specifically for your property investment. So this fund should cover what I class as unexpected expenses. And this could be property repairs, vacancies, sudden downturns in the market. Now, you can kind of plan and predict looking at the market cycle, but you don't always have yep, that's definitely going to happen. Like none of us definitely knew COVID was coming in, for instance, and that took a bit of a turn and then threw us into really high interest rates on the back end of that. So being prepared and having an emergency fund, having cash reserves allows you to kind of act quickly on investment opportunities, which rely on kind of external financing. But the best part of that is that, if you're coming out of a downturn and it's on the way up, you can start buying when the properties are at the lowest prices. And as it increases, the value of your property will increase alongside that. So during a market downturn, the cash basically gives you the ability to purchase properties at, I suppose, a discounted price. And buying when prices are low and demand is weak can lead to substantial capital appreciation, which is where the property grows in value when the market recovers, which is what a lot of people see. They're like, oh my God, I bought my house for £100,000 and it's now worth £180,000. And that's because they're in that growth phase where they, it's brilliant. If they came in at the bottom and they're riding that wave, of course, they're going to see increases in the value of their property. I'd also consider evaluating properties and focusing on underlying, I suppose, fundamentals that drive value. So these are things for you to consider like location or proximity to any amenities, transport links, and, any potential future investments or developments that are being made into that particular area. Like a property with strong fundamentals is likely to kind of perform really well over long term. And that's, I have to say, that's regardless of short-term market fluctuations. I would avoid short-term bias. So resist the temptation to make those impulsive decisions based on a short-term market movement. You'll see this when you start looking at all these figures. You'll have dips. And that's normal. Try not to think, oh my God, it's in a dip now, I can buy, because the dip could still be on the growth side and you're buying at the wrong time. Like, you have to view property investment as like a marathon, not a sprint, okay? A marathon, and adopt, I suppose, a patient approach and avoid chasing that quick buck, that quick profit, because the reality is there are things out there, but if you want to build long-term wealth, that's what you want to try and avoid, really. And I suppose it's remembering that property values tend to appreciate over longer periods of time. So providing a reliable source of wealth to you as opposed to like the here and now. And actionable steps for investors can be things like reviewing your portfolio. So if you have a portfolio already, assess how the current properties are performing in your current market cycle. identify any properties that may need adjustments or may need refinancing if you want to be able to release some capital. Look at emerging markets or areas with potential for growth. What else is there? Consider factors like infrastructure development, job growth, and I suppose population trends as well, because, certain people will move into certain areas in higher volumes because there's something going on within that area. Based on your research, so based on you looking at your property portfolio, based on you understanding the property market cycle, following the data that comes out regularly, update your investment strategies to align with the current market phase. Be sure you know when to get in, when to get out, when to hold, when to increase rents, when to understand that rents might not increase as quickly because obviously you've got house price increases. Understanding all of that makes you running a property business or a property company much more smoothly. I would also consider reallocating funds or kind of diversifying into new property types, because if you have all your eggs in one basket and something goes wrong, then inevitably it's going to be a pretty hard pill to swallow. And it's always good to talk to people who have boots on the ground. So join property investor groups or forums and listen and exchange ideas and insights. People will tell you, if you attend property seminars or webinars or whatever it might mean, they'll keep you updated on industry trends, which I think is quite important, because you may not be familiar with a certain area and you'll hear people talking about that area as an up and coming trend. There's something going on within it. It might be a new metro station being built. It could be a new tram link that's been extended. And that will mean that when you're looking at property, you're asking yourself, in that market cycle, is it the right time to buy? Can I release money from the current portfolio I have already? And what's my long-term strategy now in this property market? This, long term, but also a short term strategy. What am I looking to do over the next 18 months or 12 months, so that you understand the impact of how that market cycle is going to take your property? There may be increases in interest, for instance, so you need to counterbalance that, knowing that you've got an emergency fund in place. So that's my view of the property market cycle. And I'm going to wrap it up now, because understanding property market cycles is, in my view, an essential way of making an informed investment decision. And by recognizing the phases of the market, staying ahead of the curve, adapting your strategy and navigating that market fluctuation will, one, build your confidence, but also make you a very, very good property investor. So that's all for today's episode. If you'd like to know any more information about property market cycles, or you want to access additional resources and training, you can visit our website, www.thefemalepropertyexpert.co.uk. Or alternatively, you can drop us an email, which is support@thefemalepropertyexpert.co.uk. Feel free to reach out to us with any questions that you might have, or any topics that you'd like us to talk about or you'd like to hear more about. Thank you for your time and happy investing.